In part two, we're going to look at this question from a different tack. We're going to take a different approach to the discussion of how borrowing impacts the cost of financing, and ultimately how is price impacted by management's choice to replace equity with debt and or replace debt with equity. So changing the capital structure is the question we're asking. So we're going to first start thinking about a balance sheet. This is a balance sheet, has all the assets of the company, even those assets that might not be on the balance sheet itself: reputation, brand name, human capital. We're going to assume that all of those assets and all of the liabilities of the company are all recognized at their market values. If that is true, then the total value of all the securities has to be equal to the total value of all of the firm's assets. The left-hand side has to be exactly equal to the right-hand side. So if we use this approach, again, it's just we're looking and trying to solve for what is the value of the stock of the company. It's the assets minus the debt. So value, again, is created by the purchase of profitable assets and investments. Value is not created by the way in which a company acquires those assets and investments. So let's talk about leveraged recapitalization. This is when a firm uses some borrowed funds to pay either a special large dividend or to repurchase a significant amount of outstanding shares. So here we have a company. It's an all-equity firm. They have 50 million shares outstanding that's trading for $4 a share. They're going to increase its leverage by borrowing 80 million and then using those funds to repurchase 20 million of its outstanding shares. So again, we can look at this in a couple of stages. How did the company start? 200 million in equity, 200 million in assets. They have 50 million shares, $4 a share. After they borrow, we see the increase of $80 million in cash. They borrowed that 80 million, so we've gone to 280, and of course we still have the 50 million shares. Finally, we're going to take that 80 million in cash and we're going to buy down 120 or 80 million dollars of equity. So again, the balance sheet doesn't change from the initial to the end. We have the exact same number, the same value, if you will, but what has changed is now the shares outstanding have dropped from 50 million to 30 million. Modigliani and Miller have what's referred to as Proposition 2. We want to talk about, again, leverage, risk, cost of capital. Proposition 1 stated that equity plus debt equals the unlevered value of the company. That's also equal to its assets. If we convert that to this balance sheet concept, the value of a levered company, V sub L, L meaning leveraged, which means it has debt, will be exactly equal to the value of an unlevered company. So let's see if we can work our way through some of these formulas. Again, the formulas themselves are not all that important, I guess, but in the end we want to see mathematically how this process works its way through. So the R sub U, the rate of return here on the unlevered company, is the proportion of equity plus the proportion of debt. The cash flows, again, from holding unlevered equity You can replicate that by using some homemade leverage if you wanted to. In Proposition 2, now we're going to be looking at the cost of capital. What happens to the cost of capital when we change the equity? So the cost of levered equity equals the cost of the unlevered equity, R sub U, plus a premium for purchasing or for borrowing the money, right? So there's a proportional, that premium is proportional to the market value of the debt equity ratio. So the cost of equity is the cost of unlevered equity plus this additional piece. Now we know from earlier in the chapter, we know that the cost of equity goes up. How will we know how much it will go up? Well, it's the cost of the unlevered equity minus the cost of debt, whatever that difference is, and then you multiply it by the weight, which ultimately is the debt equity ratio, or the relationship between long-term debt and long-term equity. So again, from that formula up above, right, all equity was 15%. If the firm's financed with $500 of debt, the expected return of debt's 5%. Again, the cost of equity, or the return ultimately to equity, is that 25% that we calculated earlier. So from the previous example, this seems to hold, that there's a increase in the cost of equity. We're using debt, so now that means obviously we're losing something cheaper. But now, what is the ultimate impact on the total cost of financing? So the weighted average cost of capital, if a firm is unlevered, right, no debt, all of the free cash flows are paid out to its equity holders. So the market value risk and the cost of capital, all right, they all coincide. So then the weighted average cost of capital for the company is exactly equal to the cost of equity because it has no debt. But what happens when we add debt, right? If it's levered, then that project is going to have a weighted average cost of capital. We need to calculate that. Here is the weighted cost of equity and the weighted cost of debt. So again, in this context, right, we're talking about a pre-tax, we haven't talked about taxes yet, the cost of capital, weighted average cost of capital, equals the cost of equity for an unlevered firm, which ultimately is the cost or the return on an unlevered or a levered project, R sub A. So we're getting to the end here to try to talk about some basic ideas about what happens, right? With perfect capital markets, the weighted average cost of capital is independent of its capital structure. It's equal to the equity cost of capital if it's unlevered. In other words, no debt means the weighted average cost of capital equals the cost of equity. That makes some sense, right? I mean, if there's no debt, then the cost of capital is the cost of equity. The debt-to-value ratio is just the fraction of the company's enterprise value that ultimately corresponds to the amount of debt that it has. So what happens when we think about the ultimate costs, if you will? Well, as we can see here, and again, we just haven't seen this picture before, but we could borrow 5%, right? Here's the cost of capital. And of course, as you, here's the cost of equity, excuse me, here's the cost of equity, here's the cost of debt. And what we can see is that these two things offset each other, that the weighted average cost of capital doesn't change. So no matter how you plug in the formula here with these ratios, no matter how you do that, the ultimate weighted average cost of capital doesn't change. Now we've come an awful long ways to talk about essentially one picture, right? One picture to try to describe what's happening here. Again, let's kind of review a little bit. We know that you're going to use cheaper financing because we're going to borrow. But the act of borrowing increases the risk of capital, and that cost of capital increases dramatically as we borrow more and more money. With no debt, the weighted average cost of capital equals the unlevered cost. That makes sense. As the firm borrows, the equity cost rises, so the net effect is that the firm's weighted average cost of capital is unchanged. So this means that what? The cost of equity increases to offset the lower cost of financing. Again, said that more than one time. So let's see how this works in a formula, right? If we were to assume that the cash flows of the company are fixed, free cash flows are fixed and constant, the value of the company is the present value of all its future cash flows, and we're going to discount that using the cost of capital. So how can you increase the value of the company? Well, there's only two ways. You either increase free cash flow, and we're assuming it's fixed, so that's not an option. The only way you can increase value is to decrease the cost of financing. Since weighted average cost of capital, in our picture here, weighted average cost of capital doesn't change, it never is impacted by the change in debt, then there can't be a change in value to the firm. If there's no change in weighted average cost of capital, there cannot be a change in value. So again, let's ultimately take another picture. Let's think about this picture of risk, right? What's happening to the risk? The effective leverage on the risk of the company's securities can also be expressed by beta. We've talked about beta many times. Unlevered beta is the measure of the risk of the company as if it didn't have any leverage. It is essentially what we're going to refer to as the asset beta. The asset beta is the riskiness of the assets of the company without the influence of debt. So how does equity beta, that number that we see that's published, how does that then change as debt levels change? The equity beta, the one, again, that's the one we see that's published, is the asset beta, beta sub u, but that is offset or increased by the differences in debt, the difference between the debt of beta sub u, which is the asset beta, and the beta of debt, and then we're going to multiply that by the actual ratio of debt to equity. So again, leverage amplifies the market risk of a firm's assets. It raises the market risk of its equity. Again, we know that it increases. This is just a formula that quantifies how that risk level ultimately increases. So here we have a company, everybody's heard of CVS, has equity beta of 0.8, debt equity is 0.10. We want to estimate its asset beta, assuming it had a debt beta, its debt beta is 0. So again, how will we ultimately check this out? Well, what's the asset beta equal to? It's the proportion of equity debt times the beta of equity, the published number, plus the proportion of debt times the beta of debt. And we've already said that in this case, B sub D is 0. So ultimately, when we plug our numbers in here, we have 1 divided by 1 plus 1, 0. That's the debt equity ratio. Multiply that by 0.8, which is the equity beta. Then the asset beta of the company is 0.73. That is the beta of the company, assuming it had zero debt. That is its asset beta. Now CVS wants to increase its leverage. It wants to go from 0.10 to 0.50 with debt to equity. The question then is, what would happen to its equity beta? What would happen to that published number if they made that change? So now we just need to work our way back through the formula. Equity beta is the asset beta, 0.73, we just calculated. Multiply that by this proportion. Again, we're going to change it to 0.5. Here is the difference between the equity beta or asset beta and the beta of debt. So the new beta of this company would be 1.09. So the increase in risk is going to go from an equity beta of 0.8 to 1.09. So obviously the risk is going to increase fairly substantially. Now we can actually do this on a worksheet that's called asset beta that's provided for you in the class. The pure beta of the company, again, that's the beta that we know we started off, that's its equity beta, 0.8. Here is the debt equity ratio, it's at 10%, so it's pure play beta. That's the equity beta of the equity beta of the company is 0.72. Now when we take the 0.72, right, and we round that up and account for the financing change, the ultimate beta of the company, the equity beta that we see of the company, is that 1.09%. So the spreadsheet will help us calculate that change in beta should we want to change the financing of the company. We will then go to the capital structure and continue this conversation on for the next section.